Alright, hey everyone, today we're going into a comprehensive final review to get you fully prepared for your final exam. We'll go through chapter by chapter with questions that look closely what you might expect in your final exam. For those of you who are new here, each chapter has been covered in depth in a separate video on my channel. There I break down key formulas and step-by-step guides to understand every part of the process. Just check out those videos and leave a comment with any questions and I'll happily respond. Alright, let's get into the video. Alright guys, so welcome back to our first example for chapter 6. I'll be looking at the questions and also be giving a step-by-step analysis so it's very easy to follow. So first looking at the question, so XYZ Corporation operates two product lines, A and B. Below is the financial data for the past year. So here we have product A and product B. And then on the left we have total revenue, variable cost per unit, and then units sold. So we have 800,000 for product A, 400,000 for product B for total revenue. Variable cost per unit for product A is $50, product B is $20, units sold is 10,000 for both. Fixed cost for the entire corporation, so that means for both products, is 300,000, and then our current tax rate is 25%. So we'll be needing these later on. So the first question, calculate the contribution margin ratio for both products. So the first thing I like to do is always to write my steps. So step one, let's write our knowns. And our knowns, I always like to write our formula for the thing that we're looking for. So contribution margin is equal to total revenue minus total variable cost. And then our other formula for contribution margin ratio is equal to total revenue divided by our contribution margin. Step one, I just like to write my formulas just so I know. And then step two, we can calculate our contribution margin and contribution margin for product A. So I'll do both products. I'll start with product A. So what I like to do is I just like to recopy our formula. And then so total revenue is the first thing I want to find. So that's given, so we don't really have to calculate that. So what I'll do is I'll just click the cell that I want, click equal sign, and then select which cell I want. So 800,000, and then if I click enter, it should paste it there. And then total variable cost is the next thing I need for my formula. So variable cost, so here they're only giving us a variable cost per unit. So what I do is $50 cost per unit times the amount of units, so 10,000. So that should give me 500,000. So then my contribution margin is equal to 800 minus 500. That's 300,000. Put that in green. All right, and then our contribution margin ratio. So this should actually say contribution margin divided by total revenue. All right, so then our contribution margin ratio is equal to our contribution margin divided by our total revenue. So here we have that as well. So I'll write on the side which product it belongs to. So product A and then product A. All right, so step 3. Let's calculate our contribution and contribution margin ratio for product A. For product B. So I'll redo the formula. So total revenue. I'll just fix any typos. So total revenue for product B is 400,000. Total variable cost. Since they're only giving it to us and per unit, I do $20 times the amount of units, so 10,000. That's our total variable cost. That can give me my contribution margin. So total revenue minus total variable cost. So that's our contribution margin. And then our contribution margin ratio is equal to 200,000 divided by our total revenue, which is 400,000. So 0.5. This is for product B. All right, so that is, put these highlighted as well. So that's the answer for question 1. Calculate the contribution margin and contribution margin ratio. So now we'll go on to question 2. So I'll just get it here. So calculate the degree of operating leverage for the entire company. All right, so the first thing I like to do first is step 1. Let's write our knowns. So the formula for degree of operating leverage is equal to our contribution margin divided by our operating income. All right. So our contribution margin is equal to 300 plus 200. So since we're trying to find the entire company, we're just combining both. And then our operating income is just going to be 500 minus 300. So I'll just write here underneath. So the formula for operating income, just in case you guys forget, it's equal to our contribution margin minus our fixed cost. So just like a CVP income statement in one of the chapters that I explained, you guys can just do that and it'll give you the same thing. All right, so your operating income is 200,000. All right, so now we can calculate our degree of operating leverage. And so we have our two knowns, so contribution margin with 500,000 divided by our operating income of 200,000. So that is 2.5. All right. So that's it for question 2. So for question 3, determine the break-even point in units and sales dollars for each product. So step 1, like everything, let's write our knowns. Our knowns include our formulas, so we don't forget while we're doing the question and we know what we're working for. So break-even point in units is equal to total fixed costs divided by our contribution margin per unit. Then I'll write the second formula for break-even point in sales. This is equal to your total fixed cost divided by your contribution margin ratio. All right, so this brings me to step 2. Let's calculate our contribution margin per unit for both products. So our contribution margin per unit is equal to your contribution margin divided by the amount of units. So for product A, we can go find our contribution margin is what we calculated here. So 300,000 divided by, so you can put a slash for divide, and then you go back to the question that they gave us, 10,000 units. So that gives us 30 contribution margin per unit. And then we'll find for product B, contribution margin, 200,000, put a slash for divide, and then units sold. All right. So then this brings us to step 3 to calculate the break-even point in units. So for product A, break-even point in units, it's equal to total fixed cost. So all the way on top, total fixed cost is 300,000 divided by our contribution margin per unit. So what we just calculated in step 2, 30. So break-even point in units. So this should be not in dollars. And then product B in units. It's the exact same thing. So we have the same total fixed cost, 300,000 divided by our contribution margin per unit for product B, and this is what we calculated again in step 2. All right, so these are the two break-even points for product A and product B. I'll highlight these in green. And in step 4, let's calculate our break-even point in dollars. So the formula, I'll recopy that from on top. So total fixed cost divided by contribution margin ratio. So product A, break-even point in dollars. So total fixed cost, we can go all the way on top, 300,000 divided by our contribution margin ratio. So we calculated it here in question 1. So 0.375 for product A. And that gives us our break-even point in dollars of 800,000. And then for product B, break-even point in dollars. Total fixed cost, it's going to be the exact same thing. So 300,000 divided by your contribution margin ratio. So we can go on top again, 0.5. So you can see here. That gives us 600,000. Right, so I'll highlight that as well. All right, so that's it for question 3. So for question 4, let me get it here. So if XYZ Corporation aims for a target operating income of 200,000 after taxes for the next fiscal year, what is the total units and sales required to achieve this target? All right, guys, so like every other question, step 1, let's write our knowns. So the formula for required sales in units is equal to, open parentheses, fixed costs plus target operating income before taxes divided by your contribution margin per unit. So just two things. Just make sure you're doing it before taxes. Most cases, they'll give you a question related to after taxes, like 200,000 after tax. We need before tax. You won't get the same answer if you use 200,000 or after taxes, whatever number you get. And then as well, so if we're trying to find required sales in units, we'll be using per unit, contribution margin per unit. So I'll show you the difference if you guys forget. So required sales in dollars. So it's the same part on the top. So fixed cost plus target operating income before taxes. But our denominator, so this contribution margin ratio is what we're going to be using. Since we're working with dollars, we're going to be using ratio. All right. So then formula, we need another formula. Since we are given only the operating income after taxes, we need to calculate our target operating income before taxes. And this is equal to your operating income after tax divided by 1 minus the tax rate. All right. And then I'll just write target operating income after taxes. That is 200,000. All right, so step 2. Let's calculate our operating income before taxes. So using the formula, so I'll just recopy it. You do equal sign and then select the formula. So operating income after tax. You already wrote that down, so 200,000. And then the tax rate. If you guys look at the top of our question, it says 25%. So I'll write 25. I'll write 0.25, sorry. Doesn't really matter if you put percentage or in decimals, it won't change the answer. So our target operating income before tax is equal to our operating income after tax divided by, and make sure you write your parentheses, 1 minus 0.25. So the reason why I'm writing 0.25 in decimals is because we're using 1 minus. So 266 and 666.67. All right. So now we could find step 3. Let's calculate the required sales in units for both products. Required sales in units. I'll recopy the formula. So fixed costs, I'll just write all my knowns. 300,000. So I can get this from all the way on top. Target operating income before tax. So since we're giving after tax, now we found our before tax. So there you go. And then your contribution margin per unit is equal to, so if you go on top, where did it say here? Yeah, so here we calculated, so 30 for product A and then 20 for product B. Since we're trying to find the whole company, we'll combine these two. So that gives us 50. And now we can plug these in to find the required sales in units. Equal to 300,000 plus 266 divided by our contribution margin per unit, which is 50. So that gives 11,333.33. Step 4, we can calculate required sales in dollars for both products. All right, so formula, I'll recopy that. Fixed costs, 300,000, what we had here. Target operating income before tax. I'll scroll down a little. So 266, we calculated that as well. And then your contribution margin ratio. So this is a little different. So what we'll do is, since the ratio here, what we calculated is related to your total revenue for each product, we can't use these ones. So what we'll do is, we'll just use the same formula to find your contribution margin, which is contribution margin divided by total revenue. So your contribution margin is equal to 300,000 for product A plus 200,000 for product B. So that's, if we combine those two, that's our contribution margin for the whole company divided by our total revenue. We're given our total revenue here, so 800,000 plus 400,000. So we just combine both, and this is our contribution margin ratio for the entire company. And now using this, we can find our required sales in dollars. So make sure you write your parentheses. So 300,000 for fixed costs plus target operating income before tax divided by our contribution margin ratio of 0.4166. So sorry, this should be not in dollars, and this should be in dollars, just in case you guys get confused. So that is it. If you guys have any questions, just leave a comment below. All right, hey guys, I'll be giving you a special order example. So here, Trenton Manufacturing incurs a cost of $15 per unit to produce a part that normally sells for $30. This cost comprises of $10 in variable costs and $5 in fixed overhead costs. An overseas buyer approaches, so this should say approaches Trenton with a special order for 8,000 units and at $20 per unit. Trenton would incur an additional $2 per unit for special packaging for this order, and no additional fixed costs involved. Calculate the change in net income at Trenton Manufacturing would experience by accepting this order. So assuming Trenton has the capacity to fill this order without affecting other sales. So what we could do is first set our table, so our special order table. We'll do revenues on the side, cost, and then net income. And that down a little bit. And then on the top, it's reject order. So what happens if we don't accept it? And what happens if we do accept the order? And then lastly, like in all of the other tables, it's net income increase or decrease. All right. So for the reject order column, it's all going to be 0, since if we never accept the order, we'll never gain additional revenue, we'll have no cost associated to that order, and we'll have no income associated to the special order. If we do accept the order, our revenue is going to be, it says on the second line, 8,000 units at $20 per unit. So 8,000 times 20, that gives us 160,000. And then our cost, so here in the first line, it says the cost comprises of $10 in variable cost. So we'll put in brackets 10 plus, and then the second line, Trenton would incur an additional $2 per unit for special packaging. So we're going to do 2. That's just 12 times the amount of units we're producing, so 8,000. And that gives us our cost. So the reason why in our cost we only do 10 plus 2 and we're not including our $5 in fixed overhead costs is because fixed overhead is associated to everything. Fixed means it's fixed, it doesn't change. So with this special order, our fixed cost isn't changing, so we don't have to count it. It's included even if we accept it or not. That's why we don't include it. 96,000, and then our revenue or net income is revenue minus cost, so 64,000. So our net income increase, this becomes an increase. Since this is a cost, we have to put a negative sign beside the equal sign. So it's negative 96. And then our net income is revenue minus cost, or sorry, it should be plus, since we have a negative sign. So 64,000. So Trenton Manufacturing should accept a special order because it will generate 64,000 in net income. Alright guys, so I'll be doing a make or buy example. So this question should look similar to a mock exam that the school actually gave you guys. So maybe you guys can expect this to show up on the exam unless they do change it. But yeah, so this question is actually on Excel, so everything's already written out. But on your final exam, you'll receive it on paper, so all of this stuff won't appear on your Excel document. So just for your information, if you want to retype it from your paper or anything like that. So the first thing I'm going to want to do, so I'll read it out first. So Delta Electronics produces 150,000 batteries every year, producing at full capacity. Variable manufacturing overhead is 40% of direct labor cost, while direct materials is $2 per unit. Direct labor is 2.20 cents, so $2.20 per unit. Carbon emissions is 130 grams per unit, so make sure you guys look at that. It says grams. That'll be important after. Carbon tax is $75 per ton. All right, and then our buy, so purchase cost is $5 per battery. Buying the batteries will eliminate all variable costs, but fixed cost remains the same at 60,000. And then carbon emissions is 200 grams per unit. So that, again, this is in grams. So the first thing I would recommend to do is to create your table. So make or buy the net income if outsourcing. And then on the left, we'll have direct materials, direct labor, variable manufacturing costs, fixed manufacturing costs, purchase price, carbon costs, and then our total annual cost. So this will be the sum. Put that down. All right, and let me just make a border around this. All right, so to start off with the make column, so direct materials, so here we're giving $2 per unit. So I'll select the $2 and then times the amount of units we want to produce, so 150,000. It'll just ask me and I'll just say yes. Direct labor, I'll do the exact same thing. So direct labor, it's 2.20, $2.20 times 150. So that gives you 330. Variable manufacturing cost, it says here variable manufacturing cost is 40% of direct labor cost. So all you'll have to do is just click on direct labor times 0.40 and gives you 132. Fixed manufacturing cost, so it doesn't say anything here, But what you could see on the buy section is buying the batteries will eliminate all variable costs, but fixed cost remains the same at 60,000. So what this means is, since it stays the same, they're referring to like while we produce it, it's also 60,000. So reading that should also tell you that fixed manufacturing cost should be 60,000 over here. Purchase price, since we're not purchasing anything and we're making it, it'll be 0. And in carbon cost, so this is the section where we actually have to calculate things. So here, to make it, we have our carbon. So this is an important thing to remember, that 1 gram is equal to 1 million tons, because you'll need this to convert your grams into tons. So in our question, our carbon emissions is 130 grams per unit. So I'll do that divided by a million, sorry. And so make sure you guys click the arrow. So click on this, click on right here, increase decimal to the left, and now you can see your full number. So if you guys see 0, 0, just make sure you click that before you think there's an error. And this gives us our tons per unit. And then our total tons, so if you do our tons per unit times the amount of units we actually produce, 150,000, that gives us our total tons. And then if we take our total tons times the carbon tax per ton, so 75, that gives us 1,462.50 cents for our total carbon cost. All right, so I'll click here, click the equal sign, and then click our total carbon cost. And then I'll write the sum, select everything. So if you guys don't know how to do that, you just select the first one, hold shift, select the last one, and selects everything in between, and it'll sum everything up. All right, so for the buying part, since we're buying it, and even in the question it says buying the batteries will eliminate all variable cost, we know automatically that direct materials is 0, direct labor is 0, and variable manufacturing cost is also 0. We kept 60,000 here under fixed manufacturing cost, since it says here fixed manufacturing cost remains the same at 60,000. Right, so for purchase price, this is something we do need to include. So it's $5 per battery times the amount of batteries we need to buy. So 150,000 gives us 750,000. And then our carbon cost. So make sure this isn't the same carbon cost, since there's a different emission or amount of emission. So here I'll just write by. So again, remember 1 gram is equal to 1 million tons. And then the amount of grams that we have is 200. Sorry, 200 divided by a million. I'll move the decimal over so you can see the full number. So this gives us our tons per unit. And I'll take that times the amount of units, so 150,000. This is the total tons. And if we want to find our total carbon cost, all you have to do is just to take your total tons, so 30 times $75. That gives us 2.250 or 2,250. And I'll do the sum here. I'll take everything, and that gives us $812,250. And so net income if outsourcing, so I'll click the first 0 minus 300. So we're actually saving $300 since we don't have to. So we're saving $300 because we don't have to spend it on direct materials. So if we do the same thing, I'll just drag that down. And so we're saving $330 since if we buy it, if we outsource the batteries, we will save $330 from direct labor. And then again, we'll be saving $132,000 from variable manufacturing costs if we do decide to buy the batteries. We won't be saving anything since if we do outsource, if we do buy the batteries, our fixed manufacturing cost remains the same. If we do buy it, our purchase price does increase by $750. And if we also outsource, our carbon cost increases by 787.5. But does this make it? So the final one, 812, 823. So that means we are saving 11,212.50 cents if we do outsource it. So this is our answer, or pretty much tells us what to do. So we should actually outsource it. We should buy the batteries because we are saving 11,212 if we do end up doing that. So let's say if we do make it, if we decide let's just make it, we'll be spending $823, 823,000, sorry. If we do buy it, we'll only be spending 812. So it's much better for us to buy it because we'll be saving money. All right, guys, so I'll be giving an example for sell or process further. So here, Joe's company sells keyboards for $25. Production costs are $12 variable and $8 fixed. Joe is considering adding LEDs to the keyboards and selling it for $35. Variable cost to add LEDs is expected to increase to $9. And then fixed costs are expected to increase to be $2. So should Joe continue to sell keyboards without LEDs or process further and add LEDs? So the first thing we're going to do is always set up our tables. So we have sell, process further, and then net income decrease, increase that. All right, and then we have our sales per unit, our cost per unit. So in this question, we don't have any direct materials or direct labor given to us. So we're just going to include variable manufacturing overhead and fixed manufacturing overhead. And then lastly, our net income per unit. And now we can calculate everything. So I'll put a line here. All right, that's fine. So sales per unit, if we sell it straight up without any LEDs, so that's $25. If we process further, that's 35. And let me just add this part. All right, so the cost per unit, so variable manufacturing overhead. So they give us on line 2 says $12 for variable and $8 for fixed. And I'll put everything in dollars just so it's more clear. So net income per unit. So what we're going to do is our sales per unit minus our cost. So it's going to be 12 and then minus 8. So that's $5 net income. All right, so if we process further, we get 35 is what we written down before. And then variable manufactured overhead. So here it says 9, but what you want to do is add it. So it's going to be 12 plus the 9. And then fixed cost is expected to increase to be $2. 2. So now we could do the exact same formula or steps to calculate your net income. It's your sales per unit minus your variable minus your fixed, and that gives us 4. So now let's look at the net income decrease or increase. So our net income does increase if we process further since we'll be increasing the selling price. If you look, I'm just doing that. So if we process further, our net income is increasing for variable manufacturing. So we have to produce $9. So we're using $9 extra per unit. And it's going to be the same for the fixed manufacturing. We're using $2 extra. And so if we go here, our net income actually decreases by $1. So this is pretty much our answer. And this tells us that we should not process further. We should just sell it the way it is without adding LEDs. Because if we do process further, we'll be losing $1. All right, guys, so we have a retain or replace equipment example. So here, Zach AI Corporation uses supercomputers. Zach wants to know if replacing the old supercomputer will be efficient for cost. So here we have the data for old supercomputer and the new supercomputer. So we have original cost, so that's $160,000 for the old supercomputer and $240,000 for the new one. Accumulated depreciation is 120 for the old supercomputer, and the estimated life is 4 years for both. So the new supercomputer will produce annual cost savings of 55,000. The old supercomputer can be sold to a scrap dealer for 24,000. Both supercomputers will have zero salvage value at the end of their lives. What salvage value means is at the end of their estimated life, so 4 years, how much can we sell the supercomputers for, or any machine? If it says zero salvage value, that means our supercomputers are worth nothing at the end of their 4 years. We can't sell it for anything. So, should Zack AI Corporation purchase the new supercomputers? So, the first thing we're going to do again is create our table. So, let's retain the computer, or let's replace the computer. And then we'll have our net income increase or decrease. We have cost savings, new computer cost, and then sale of old computer. And then net savings, and I'll put a sum at the end here. All right, so cost savings if we keep the computer, so we're not saving anything. New computer cost, since we're not purchasing the new computer, it'll be zero. Sale of old computer, since we're keeping it, it'll be zero. So our net savings will be zero. This one's pretty straightforward. Now to replace the computer and to purchase the new one, so cost savings. So it would actually be 220. So here, the new supercomputer will produce annual cost savings of 55,000. So what we do is 55,000. But since it says annual cost savings, so make sure you really pay attention to the wording. So we're going to want to do 4 years, since that's what it says right here. The amount of years we'll be keeping the computer for is 4 years. So, sorry, this should say new computer cost. And so the new computer cost that's given to us in the question, 240,000. And then the sale of the old computer. So you can see here, the old supercomputer can be sold to a scrap dealer for 24,000. And once again, I'll put this in dollars. And so our net savings, so if it costs us 200, if we're saving 220, and sorry, actually this should be in the negative, just so it's clear that we are spending 240. So it'll be 220 plus, since this is a negative, we're going to be adding it, and then plus the 24,000. So our net savings is 4,000 if we do purchase the new computer. And our net income decrease or increase, it's just going to be the same, since our retained computer is all zero. And so this gives us our final number of 4,000. So what this tells us is that replacing the computer and purchasing the new supercomputers will actually save us $4,000. So this is the answer. We should replace the computer. Alright guys, so we have an eliminate or continue a segment example. So here Charlie sells a premium chains, and his silver chains had sales of 400,000, variable cost of 310,000, and fixed cost of 120,000. If Charlie eliminates his silver chains, 20,000 of fixed costs will remain. Should Charlie eliminate his silver chains? So the first step we want to do is let's create our table. So we have continue to make the silver chains, or let's eliminate it. And we have net income increase or decrease. Let me just fix that. All right, and then here we have sales, variable costs, contribution margin, and then their fixed costs, and then net income. So this looks exactly like your CVP statement from chapter 6. All right, now let's just make that bigger. I'll get rid of this. All right, so if we continue, so our sales was 400,000, our variable cost was 310,000, and our contribution margin, if you guys remember, it's sales minus variable cost, so 90,000. Our fixed cost is 120,000. And this is all given on the first line. So here's your sales, variable cost, contribution margin is calculated, and then your fixed cost. I'll put this in dollars again. So your net income is contribution margin minus your fixed cost. So we're actually losing 30,000 from producing the silver chains. So if Charlie eliminates the silver chains, his sales go to 0, his variable cost is 0, and his contribution margin is 0 since there's no sales or variable cost. So your fixed cost, it says in the second line, 20,000 of fixed cost will remain. So let's put 20,000. And so contribution margin minus your fixed cost gives you your net income. So if we eliminate it, we are losing 20,000. So here, our net income are decreased. So if we decide to eliminate it, we are losing 400,000. So that's why I put a negative here, because this is the money we could have gained if we continued it. We save 310,000 because we eliminate it. We lose, so 400 minus 310. Oh, sorry, it should be a plus. We lose 90,000 of contribution margin. And our fixed cost will be 100,000. So if we look here, our contribution margin plus our fixed cost, this should be a minus, but since we have a negative number, we have to put a plus, and it gives us 10,000. So this gives us our answer. So if we do eliminate it, the silver chains, we will increase our net income by $10,000. So Charlie should eliminate his silver chains. Alright guys, so here's our example for sales mix with limited resources. So here Noah sells 3 types of chocolate. We have dark, white, and caramel. Noah requires more time making the white and caramel chocolate. So what we see here is we have dark, white, and caramel. We have the selling price for each chocolate, so 6, 10, and 16. Variable cost and expenses, 4, 6.5, and 11. And your contribution margin per unit, so that's $2, 3.5, and $5. And then the machine hours required, so 0.02, 0.04, 0.08. And then on the bottom, we have our total fixed cost of 234,000. So the question here is, what strategy would be the best, ignoring the machine time constraint? So we don't want to look at this. So we want to use all of this stuff and our total fixed cost if we need it to figure out what the best strategy is. So the strategy, and I'll write it out for you guys, should focus on the product with the highest contribution margin per unit. This is because this will maximize profit for each unit sold. And why are we looking at the highest contribution margin? So why do we even care about this part, contribution margin per unit? So this is something you have to remember, and hopefully you guys do remember this already. So contribution margin contributes to covering fixed costs. So if you have a low contribution margin, so let's say if we look at the dark chocolate, this is the lowest one. The dark chocolate covers fixed costs at a lower rate than the white and caramel. So our answer, so we want to look at which one covers fixed cost the most, and what that means is look at the contribution margin with the highest number. So our answer would be the caramel with $5. Since this has the highest contribution margin per unit, this is going to cover fixed costs the most. All right, so for the second question, we have B, calculate the contribution margin per unit of the limited resource for each type of chocolate. So what I'm going to do is just recopy this heading. And then what this pretty much means is we want to take into account the machine hours required. So this might change our answer, since we just calculated, or we just found the product with the highest contribution margin, but now we have to take into account that some of them have higher hours to produce, and that could play a role in our contribution margin per unit. So first, let's get this part, contribution margin per unit, the machine hours required. per unit, and our contribution margin. All right, so that would be here. And machine hours required per unit, right here. And so to find the contribution margin, so this would be in dollars, we take our contribution margin per unit divided by the machine hours required per unit. So that gives us $100 of contribution margin per unit, 87.5 and 62.5 for the caramel. So we are dividing the contribution margin per unit by the limited resource, so the machine hours, because this helps us identify which product offers the highest return per unit of the constrained resource. So doing so helps us clarify that yes, the dark chocolate does have the lowest contribution margin per unit, but if we do take into account that it has the lowest machine hours required, we can then see that it does have the highest contribution margin per unit in terms of profit. So it's much more better for us. So this is actually our answer. It's much better for us to produce our dark chocolate because it has the highest contribution margin. So make sure you guys, if that ever becomes a question, make sure you take into account your machine hours required. And how I did that is just your contribution margin per unit divided by your machine hours required per unit. All right, guys, so we have our chapter 8 costing methods example here. So we are given 2 years, so 2023 and 2024, units produced and sold. So for 2023, we have 25,000 units produced, and then units sold, we have 18,000. And 2024, it's the exact opposite, where we have 18,000 units sold, produced, and 25,000 units sold. So in 2023 and 2024, so it's the same in both years. Selling price was $100. Direct material cost is $20 per unit. Direct labor cost is $10 per unit. Variable manufacturing overhead is $10 per unit. Variable selling expenses $8 per unit, and fixed manufacturing cost is $540,000. Fixed administrative expenses is $200,000. So the first question we're looking at today is, what are the unit product costs under throughput costing in 2023? So first, to do this, let's write down, so let's remember our unit product cost for throughput costing. So if you guys remember the chart that I showed you guys, so for unit product cost, it's just direct materials for throughput costing. What I'll do is I'll go on the side here, I'll write throughput costing, and on the left, direct materials. And we're looking at in here, so just the cost, so $20. So this will be our unit product cost. So that is pretty simple, it's very easy. So B, what are the unit product costs under absorption costing? So let's remember unit product cost for absorption costing. Absorption costing is equal to direct materials, direct labor, variable manufacturing overhead, and then fixed manufacturing overhead. So it's everything that's used to produce or manufacture the product. So here I'll do the same thing. So absorption, I'll rewrite everything. So direct materials, direct labor, variable manufacturing overhead, and then fixed manufacturing overhead. And this is going to be on a per unit scale. So direct material cost, $20 per unit. Direct labor, so I'll scroll down more, $10. Variable manufacturing overhead, it's 10. Fixed manufacturing overhead. So here they're giving us the totals, 540,000. So you want to divide this by the amount of units produced. So that gives us 21.6. So if we do the sum of all of these, that gives us 61.60. So this is our unit product cost. I'll highlight that in orange. So that is the answer to B. So for C, what are the unit product costs under variable costing? So now we'll look at all three examples. the unit product cost for variable costing. If you guys remember this from the chart as well, it's direct materials, it's direct labor, plus a variable manufacturing overhead. So it's anything that varies in the production or changes through production. Variable costing. And so I'll just copy this. And click that. Right, so that should just be $40. Let's click the sum here. And unit product cost. So this is very easy. This can be easy marks for your final exam. They just want you to know, if you remember, if throughput is direct materials, if absorption is all, and then variable costing is direct materials, direct labor, variable manufacturing overhead. All right, so this brings us to our question D. So what is the contribution margin amount in 2024? All right, so to do this, I'll write it down into steps. So step 1, let's write our knowns. So our formula for contribution margin is equal to sales minus your variable cost. So step 2, let's calculate our sales. So sales is equal to selling price times your units sold. So your selling price, this is 100. Units sold, this is all the way on top. So this is for 2024. Units sold is 25,000. So make sure you guys click the right year. So maybe they'll try to trick you on the years that they use. And so the sales is equal to 100 times 25,000. So that gives us 2.5 million. So step 3, let's calculate our variable cost. And then variable cost is equal to our variable overhead per unit plus our variable selling and admin times the amount of units sold. All right, so variable overhead per unit, this is what we calculated already. So right here, variable costing. Now we have to find our variable selling and admin. This is given to us already in the question. So variable selling expenses, $8 per unit. And so our variable cost, I'll get rid of this and put the parentheses. So 40 plus 8 times the amount of units sold. So units sold is right here. So 1.2 million. Now step 4, we can calculate our contribution margin. And I'll just recopy the formula. So sales minus variable cost. So sales is equal to 0.5. Variable cost is equal to 1.2. And so our contribution margin is equal to 2.5 minus 1.2. So you guys can see, so this would be our answer, 1.3 million. So you guys can see that chapter 8 and many of the chapters in the second half of the final exam does use a lot of concepts from chapter 6. So I would really recommend that you guys get familiarized with chapter 6, the formulas, the CVP income statement, what contribution margin is, and everything like that, because that could be very crucial for your final exam. So let's go to the last question here. So E, what is the difference in operating income between absorption and variable costing in 2023? So to do this, we're going to have to create both an income statement for absorption costing and variable costing. So step 1, let's create the absorption income statement. To do this, I'll just right here. So usually you want to write on the top your company. So company, I'll just write company A. All right, income statement, absorption. And then for the year 2023 is what they're asking for. So on the left side, this is the components of our income statement. Now merge these. So we have sales, we have cost, your cost of goods sold. And that gives us our gross profit once we calculate that. So I'll put a line gross profit, and then we have our period costs for the variable, selling, and admin. Fixed, selling, and admin. And then our total period cost. And then finally, we have our operating income. All right, so for our sales for the year 2023, we can go all the way up. So units sold is 18,000 times the unit selling price, so $100. That gives us 1.8 million. So cost of goods sold for absorption. So we can go find where unit product cost. Then we want to times this by the amount of units sold. Since it's the cost of goods sold, we want to find the units. We want to times it by the units sold. So that gives us our gross profit minus, so 691,200. And then period cost, so I'll put this more just so you guys can see that it's on the side. Variable, selling, and admin. So we can scroll up again. This is given, so it's $8 per unit times the amount of units sold. Fixed, selling, and admin. That's just given to us. So admin expenses, 200,000. So total period costs, I'll just combine these two. And our operating income is gross profit minus our total period cost. So 347,200. So that is for our operating income for absorption. Now step 2, let's create our variable income statement. All right, so the same thing, I'll just recopy this. And I'll change this to variable. So for variable income statement, we have sales, we have variable cost of goods sold, we have variable selling and admin, we have your contribution margin, you have your fixed manufacturing overhead, and then your fixed selling and administrative expenses. All right, and then that gives us our operating income. I'll just put a line here just so we know that there's a calculation done. So sales, that's going to be the exact same sales, so 1.8. Variable cost of goods sold, so I'll go find on top variable cost of goods sold. So this is why it's crucial to get the calculations and to make sure you memorize how to calculate your unit product cost for variable costing and for all the different costing methods, because you'll be using those for the later questions. So for this, it's 40 times the cost, the amount of units sold, so 18,000. So that gives us 720. Variable selling and admin, so I believe it should be the same. So 100, it should be the same as the absorption, but I'll just recalculate it just to be safe. So 8 times the amount of units sold, 144. Contribution margin, it's sales minus your variable cost minus your variable selling and admin. So 936. Your fixed manufacturing overhead, you can scroll up to find that. So it's 540. And your fixed selling and administrative expenses, this is also given. So that's 200,000. So your operating income, you can get your contribution margin minus your fixed manufacturing overhead minus your fixed selling and administrative expenses. So that gives us 196,000 for my operating income for variable costing. So step 3, and this is the last step, let's calculate the difference. So we have absorption costing, right? Operating income for absorption, and that's 347,000. And then the operating income for variable, that's 196,000. All right, and the difference in operating income It's 347 minus 196. So that is our answer, 151.2. So it's fairly easy. I would just recommend that you guys familiarize yourself with how to calculate the cost of goods sold and how to calculate your income statements for variable, for absorption, and for throughput. All right, guys, we'll do our chapter 9 examples. So Jeff's company manufactures and sells books. The book manufacturing division sells its products to customers for $15 each. Variable cost per tire is $7.5. Fixed cost per tire is $3. The book assembly division buys its resources from an external client for $13 each. Management wants the book manufacturing division to transfer 50,000 books to the book assembly division at a price of $12 per book. The book manufacturing division is operating at full capacity. So what is the minimum transfer price? So step 1, let's write our knowns. So minimum transfer price, if you guys remember the formula, it's a variable cost per unit plus opportunity cost. All right, I'll put that. And opportunity cost is equal, and I'll put two brackets here, the selling price minus a variable cost times units foregone. Put that in here, units foregone, and divided by units transferred internally. All right, so that's our two formulas that we need for this question. So step 2, we can calculate our variable cost per unit. So variable cost per unit, and that gives us 7.5, and the 7.5 is from the second line right here. And so step 3, let's calculate our opportunity cost. And our opportunity cost is this formula. We have selling price, which is $15. You can see 15 from the first line up here. We have variable cost, so 7.5, and these are all in dollars. So just so it's more clear for you guys, I'll put this as well in dollars. Units foregone is 50,000. Units transferred internally is also 50,000, and this should be in units. So our opportunity cost is going to be, and make sure you guys put your brackets if you're doing this, so selling price minus variable cost times your units foregone divided by the units transferred internally, and make sure I close the brackets here. So that gives us $7.5 is our opportunity cost. This brings us to step 4 to calculate our minimum transfer price, and I'll just rewrite the formula so we know what we have to include. So variable cost per unit is, we calculated the 7.5, and then opportunity cost is as well 7.5. So our minimum transfer price is equal to 7.5 plus 7.5. So this is our answer. Sorry, this is our answer. All right, so for question B, what is the maximum transfer price? And this is a very easy question, and they might even ask you this on the final, and this is just easy points. So the maximum transfer price is equal to your market price. So the market price at which you're selling the books for is 15. And this is again from the first question or first line. So that's pretty much, that's all you need to know for the maximum transfer price. All right. So question C, will the book manufacturing division gain or lose by transferring, and by how much? So to do this, I'll look at the minimum transfer price. which is $15. Since this is what we just calculated, so it's more clear, I got it from here. And then our transfer price, which is, says it right here, the $12 per book is what we're transferring it to. So your transfer price is 12, and our gain slash loss, this is what we're gonna have to calculate. So it's, the transfer price is 12 minus the 15 times the amount of units, so 50,000. So we're losing, or the book manufacturing division is losing 150,000 by transferring. I'll highlight that. So that is our answer. And then for D, will the book assembly division gain or lose by transferring, and by how much? So for this one, we look at the assembly purchase price. So how much are they purchasing the product? This says it right here. It buys its resources from an external client for $13 each. And our transfer price is $12. So you guys can see that for them, they're purchasing the books for $12 instead of $13. So we should receive a gain for this division. What we'll do is 13 minus 12 times 50,000, which is the amount of units transferred. And we could see we have a gain of 50,000. So that is it. This is all you have to know for chapter 9. It's not a big chapter for the final exam, but these are some of the questions that they may ask you. All right, guys, so welcome to our chapter 12 example. So this should look similar to a past exam or an exam like question. So here we have standard cost for one unit is as follows. We have direct materials, direct labor, and manufacturing overhead. So for the quantity of direct materials, it's 3 kilograms. Standard price is $28 per kilogram, so the cost is $84. Direct labor is 2 hours. Standard price for direct labor is $22 per hour, and the cost is $44. And manufacturing overhead is 2 hours, 48 hours, and $96. So in total, that's $224. There was a production of 400 units, so that's the total units that we're producing. Here are the actual manufacturing costs incurred. So in your exam, you might receive a bunch of data like this. And what you'll need to do with this is actually create a pivot table. So you want to select everything. So what I do is I click the first one, hold shift, click the second, and then hold control shift, and then the down arrow key, and selects everything. And you want to go on the top, click insert, pivot table, click existing, and I'm going to move it somewhere to the right because I don't want to get in the way of our questions. So it should see something like this. And so if you guys have dates, so if the question specifies a range of dates like only in September, only in August, only in October, then we would have to filter those dates. Since all of these dates that we have are all in August, will just be used, we won't have to filter anything. So what I'll do here is put the cost types, so depreciation, direct labor, direct materials, factory rent, indirect labor, indirect materials, and utilities, and then incurred amount and quantity incurred in our values. So one thing you guys have to make sure is that you want to change this. So here it says the sum of the incurred amount. So this is the sum of all direct materials. And this says the count. What we want to do is change the count. So click out here on the values. Go to value field settings. And then here you could change it to sum. So this is the important part. So what we need for this question, so question A is looking at direct material price variance. So what I'll do here is just select direct materials. So now we can see incurred amount and then sum of quantity incurred. This is going to help us use it for our price variance and our quantity variance. All right, so to figure out our direct material price variance and if the variance is favorable or unfavorable, we'll do this into steps. So step 1 is to calculate our, I'll write it out, calculate our direct materials actual cost and actual quantity. So I'll create a table here. So actual cost, then actual quantity. Let me make that nicer. And then here we have direct I'll write DM for direct material and then actual. All right, so since they tell us that all this data is the actual manufacturing cost incurred, we'll be using that for our step one. So actual cost is gonna be 32,850. So that's 32,850. Our actual quantity is 1,019. So that's our step one. Our step two is to calculate our actual price. And so actual price, I'll write the formula, is equal to actual cost divided by actual quantity. So what you guys can do is I'll put this table and I'll put another column for actual price. And then you could just do your formula. So actual cost divided by actual quantity, that gives you 32.24. So for step three, we can do calculate our standard quantity per unit and standard price. And if you guys are wondering where I'm getting these steps, you guys can go look at my video on chapter 12 where I give a step-by-step analysis on how to solve your variance questions. So it details that step one is to actually calculate your actual cost, actual quantity, and all of that. And as well, you guys can find all the formulas in that video as well. So step three, it's to calculate our standard quantity per unit and standard price. So I'll redo another table. So standard quantity per unit and then standard price. We space that out. And then our direct material standard. All right, so this standard quantity and standard price is always given into your question. So this is the first thing that we saw. So standard quantity per unit, that's 3 kilograms. Since we're looking at direct materials, so right here. Our standard price is going to be 28. Per kilogram. So that is what we need. But for step four, I'll make this bigger just so you guys can see better. Step four is to calculate our standard quantity. And so standard quantity is equal to standard quantity per unit times the amount of units produced. So our standard quantity per unit, I'll redo the table. So I'll have this table, paste it like that, and I'll put another one, standard quantity. So we said it's a standard quantity per unit, so I select that times the amount of units produced. The amount of units produced says here 400 units. So I'll write 400, and that's our standard quantity. Now step 5, we can calculate our material price variance. And I'll write the formula here. So material price variance is equal to actual price per unit minus standard price per unit times actual quantity used. All right, so we have all of these already. So I'll just write our material price variance. Let me make this bigger. So our actual price, and make sure you put your parentheses when you're doing this formula. So actual price per unit is right here, minus your standard price, it's right here, times your actual quantity used. Actual quantity is right here. And so that gives us a material price variance of 4,318. And so they want us to know if it's favorable or unfavorable. And if you guys don't know this, well, I detailed it in my video as well, my chapter 12 video. So this is going to be unfavorable. And there's two ways to knowing this. First, if this is a positive number, you would automatically know that it's unfavorable. And because our actual price is greater than our standard price. So what this means is when we're looking at our actual price, so what's in blue right here, 32, and our standard price is 28, that means that we are producing $4.24 more than we're supposed to. If the standard price is 28, but we're actually producing the unit at $32, then that means we're producing it at a higher cost than we need to, which is not good for the company. That's why it would be unfavorable. All right. So for our next question, so direct material usage variance is the variance favorable or unfavorable. So this is very easy. Since we just did all these steps already, we can now, our direct material usage variance is very easy to calculate. So I'll just write the formula. So it's actual quantity minus standard quantity times your standard price per unit. All right, and so our actual quantity, we have that here, 1019. Our standard quantity is equal to 1,000. We had it somewhere, standard quantity right here, standard, and then standard price per unit right here. So our quantity, and we can just combine all of this to calculate our quantity variance. So our actual quantity minus your standard quantity, close the parentheses, times your standard price per unit. So it gives us a negative number. So it's 5,068. I'll put into dollars. So if it's negative, you would know that it's favorable. And another way is saying that your actual quantity is less than your standard quantity. You guys can see here, our standard, so what the standard quantity should be is 1,200. What we actually use is 1,019, which is way less. So that means it's favorable for us. So I'll highlight that. That's the answer. So C, total direct material variance. So let's look at the formula. Total material variance is equal to price variance plus quantity variance. And so our price variance, this is just combining what we found in A and B. Our price variance is 4,318. Our quantity variance is what we just calculated. And then our total material variance is equal to price plus quantity. So 750. And this is also favorable because it's in a negative. All right, so that's our answer for C. It's a very simple one. So now our direct labor rate variance, and is the variance favorable or unfavorable? So don't get confused if you guys see rate. Rate just means price. It's just a way of tricking you guys, but if you guys just know that it's price variance, then it's the same exact steps that we just did in question A. So the first thing we have to do is go look at our pivot table up here. So right now we only have direct materials, so we want to select direct labor. And so we could use this. So I'll create the table. So step 1, calculate our actual cost and actual quantity. So actual cost, I'll just create the table again. Direct labor actual. So actual cost was 3,200 and 3,200, 600. Actual quantity is 1515. All right, there you go. So that's all we need from the pivot table. And so step 2, we can calculate our actual price. So like we did again, I'll just redo the table, make another column for actual price, and take your actual cost divided by your actual quantity. That gives us 21.52. And now brings us to step 3. So calculate our standard quantity per unit and standard price. So let's write that out again. Standard quantity per unit and standard price. Direct labor standard. So we can go find on top our standard. Just know that your standard is what's given most of the time. So direct labor quantity, so that would be 2. And your standard price would be 22. All right. So that's step 3. Step 4, we can calculate our standard quantity. So I'll redo this table. All right. Standard quantity. So our standard quantity is equal to your quantity per unit times the amount of units. Like we said before, just to make it clear, there was a production of 400 units. So we just do that times 400. That gives us a standard quantity of 800. So this brings us to step 5 to calculate our material / labor price variance. So price variance, once again, I'll redo the formula just so it's clear. And this might be something that you guys have to remember for your final exam. So standard price per unit times actual quantity used. So your actual price per unit is $21.52. Your standard price is 22. Your actual quantity used, actual quantities right here, 1515. So then your price variance can now be calculated. So open parentheses, click your actual price per unit minus your standard price per unit times your actual quantity used. So that gives us a negative. This makes sense because our actual price per unit is less than the standard price. So this would be favorable because actual price is less than standard price. All right, so here's the answer to D. And here's our last question. So E, direct labor efficiency variance, is the variance favorable or unfavorable? Just know efficiency is just another way of saying quantity. For quantity variance, once again, this is something you guys will have to remember for the formula. Actual quantity minus standard quantity times standard price per unit. So I'll write down everything that we need. So actual quantity, standard quantity, standard price per unit. All right, so actual quantity, let's go find that. So 1515, standard quantity 800, standard price per unit, standard price is 22. So there you go, we have everything already. So actual quantity 1515 minus standard quantity of 800, close the parentheses, times our standard price per unit. All right, so that gives us 15,730. So what do you guys think? Is this favorable or unfavorable? This would be unfavorable. And why? There's 2 ways of knowing. Since it's a positive number, it should be unfavorable. And because your actual quantity is higher than your standard quantity. All right, so there is our answer. All right, thank you.